March 2025. Silver in London trades at $62.30. Same moment, Shanghai, $63.85. That's a $1.55 difference. You know what that means? It means the global price for silver just broke. For 150 years, one price, one market, one center of control, London. Now there are two prices, and they're moving further apart every day. February 14th, South Korean banks stopped selling physical silver, not because they wanted to, because they couldn't get it from London anymore. March 21st, spreads between London and New York exploded past $1 per ounce. In normal markets, that spread is 3 cents. When it hits $1, something is fundamentally broken. And right now, something catastrophic is happening that shouldn't be possible. The West is losing the ability to set silver prices. After 150 years of London being the center of the silver universe, the Chinese just figured out they control the physical metal, and they're done accepting Western paper prices. This is stage 2 of a 3-stage pattern that's destroyed every commodity pricing system that tried to separate paper from physical. And when stage 3 fully hits, the Western exchanges won't just lose control, they'll become irrelevant. By the end of this video, you'll understand exactly how pricing systems collapse, why two billionaire brothers saw this in 1980 and almost broke COMEX, and what it means when the world's most strategic industrial metal suddenly has 2 different prices depending on which hemisphere you're standing in. Let me give you the pattern. It's happened 3 times in modern history, and it's devastatingly simple. Stage 1, centralized pricing, one exchange, one price, global acceptance. Everyone trusts the system. For silver, that was London. The London Bullion Market Association, LBMA. For 150 years, whatever silver traded for in London, that's what it cost everywhere else. The price moved from London to New York to Shanghai to Mumbai. One price, instant transmission, global trust. Stage 2, the fracture. Physical supply concentrates in one region. Paper claims concentrate in another. The regions start trading at different prices because one has the metal and one just has contracts. Arbitrage, the mechanism that keeps prices aligned, breaks down because you can't move physical fast enough or at all. Stage 3, the split. 2 separate markets emerge. The region with physical metal sets the real price. The region with paper watches its pricing authority collapse. Contracts get settled in cash. Physical trades at massive premiums. And everyone holding paper in the dying market learns an expensive lesson about the difference between owning something and owning a claim on something. That's the pattern. And I'm going to prove to you, using exchange data from this month, that we're deep into stage 2 and accelerating into stage 3. But first, you need to understand why silver pricing authority matters more than any other commodity on Earth. Gold is just money. Silver is money and the most critical industrial material in modern civilization. Your phone, silver. Solar panels, silver. Military electronics, silver. 5G infrastructure, silver. Every missile, every satellite, every AI data center, silver. China controls 40% of global refined silver production. They're the world's largest importer, and they just restricted exports. The United States imports 70% of its silver, Europe 80%, and we're in our 5th consecutive year of global supply deficit. 63 million ounces short in 2025, according to Metal Focus. The solar industry alone could consume 85 to 98% of all silver reserves by 2050. When you control the physical supply of the world's most strategic industrial metal, you control the price. Not New York, not London, the country with the metal. And right now, that's China. Watch what happens when we apply this pattern to the most dramatic pricing war in commodity history. Let me take you to Texas, 1979. Nelson Bunker Hunt and William Herbert Hunt, 2 billionaires. They had a theory. London and New York were setting silver prices with paper contracts, while the physical metal was somewhere else entirely. So they started buying, not just futures, physical delivery, 200 million ounces. They weren't trading silver. They were removing it from the system and forcing the exchanges to admit how much physical actually backed all those paper claims. January 1979, silver at $6 per ounce. September, $10. December, $30. By January 17, 1980, silver hit $49.45. That's 724% in 12 months. The Hunt brothers were worth billions. They were the richest men in America. And COMEX was in a complete panic. Why? Because the Hunts weren't just buying contracts and rolling them forward like normal traders. They were demanding physical delivery, taking metal out of COMEX vaults, draining London, shipping it to Switzerland where the exchanges couldn't touch it. And they were exposing the core problem. COMEX had issued far more paper claims than it had ounces in its vaults. Every futures contract is a promise to deliver physical silver. If enough people demand that physical silver simultaneously, the exchange fails because the metal simply doesn't exist. The Hunts were doing exactly that, forcing delivery. emptying the vaults, creating a squeeze that would expose the paper market as a fraud. COMEX had two options: admit they didn't have the metal and watch the exchange collapse, or change the rules mid-game. They changed the rules. January 7th, 1980. Silver Rule 7. You can sell, you can hold existing positions, but you cannot buy new long positions. Translation: we're stopping the hunts from buying more because if they keep demanding delivery, we're done. But silver kept climbing anyway because the supply problem was real. Until January 21st, when COMEX raised margin requirements drastically. Overnight, holding futures became impossibly expensive. The hunts needed hundreds of millions in additional margin. They scrambled, they sold, others panicked and sold. March 27th, 1980, Silver Thursday. Silver collapsed from $21 to $10.80 in a single day. The Hunt brothers lost $1.7 billion. They declared bankruptcy. Brokerage houses teetered. Banks froze credit. The entire financial system nearly broke. But here's what everyone forgets. The people who held physical silver, not futures, not COMEX contracts, but actual metal in their possession, shipped to private vaults, they didn't lose anything. When the dust settled, silver stabilized around $10, still 66% higher than where it started. The Hunt brothers failed because they used leverage and trusted the exchange to honor its contracts. The exchange changed the rules, but you can't change the rules on metal sitting in a private vault in Zurich. That lesson matters because we're watching the exact same pattern play out right now, but instead of two Texas billionaires, it's entire nations. And instead of COMEX changing margin requirements, they're losing pricing authority altogether. The Hunts tried to break one exchange. China is breaking the entire Western pricing system. This isn't the first time physical concentration in one region broke a commodity pricing system. 1971, Nixon closes the gold window. Foreign central banks, especially France, were demanding physical gold for their dollars. The U.S. didn't have enough gold to cover the dollars in circulation. So Nixon ended gold convertibility. Within a decade, gold went from $35 to $850, and the U.S. lost its gold pricing authority to London and Zurich. 2001, Russia and palladium. Russia controlled 60% of global palladium supply and mysteriously delayed shipments for months. Physical vanished from Western markets. The paper market in New York kept trading, but prices diverged wildly from actual transaction prices in Moscow. Western traders holding NYMEX contracts got crushed. Physical holders in the East made fortunes. 2018, cobalt and the Congo, 60% of global supply. China locked up long-term physical contracts directly with Congolese miners. London Metal Exchange still traded cobalt futures, but Chinese physical buyers ignored LME prices and paid premiums directly to secure supply. 3 examples. Same pattern, same outcome. Physical concentration in one region breaks paper-based pricing in another. Control the metal, control the price. So where are we right now with silver pricing authority? Let me show you using data from this month. Stage 1 complete. For 150 years, London set the global silver price. The LBMA silver price, established twice daily, became the benchmark for every contract, every transaction, every vault settlement worldwide. Shanghai, New York, Mumbai, everyone referenced London. Arbitrage kept prices aligned within pennies. If London traded at $30 and Shanghai at $30.05, traders would buy in London, ship to Shanghai, and capture the 5-cent spread. That arbitrage pressure kept global prices synchronized. The system worked because physical could move freely, vaults were open, and everyone trusted the pricing mechanism. Check. Stage 2 is active right now. Let me prove it with the mechanics of how this is breaking. Think of arbitrage like this. If you can buy silver in London for $60 and immediately sell it in Shanghai for $62, you make $2 profit per ounce. Traders do this millions of ounces at a time, and their buying in London and selling in Shanghai naturally forces the prices back together. That's what keeps one global price working. But arbitrage requires 3 things: access to both markets, ability to move physical metal, and vault space to receive it. All 3 are breaking down. February 14th, 2025, 4 major South Korean banks announced they could no longer source physical silver from London for customer delivery. Not temporarily, indefinitely. These are banks with billions in capital and direct relationships with LBMA market makers. If they can't get metal out of London, who can? March 2025, the spread between London and Shanghai, which should be pennies, exploded past $1.55 per ounce. In commodity markets, that's not a spread. That's a breakdown. What's causing this? The technical term is EFP, exchange for physical. Think of it like the stress indicator of the silver market. It measures how much more you pay to get physical metal right now versus a futures contract promising metal later. Normal EFP, 3 to 10 cents. Current EFP, over $1. That means people are paying $1 premium per ounce just to get physical instead of paper. That's panic. Shanghai Silver Exchange inventories hit their lowest level since 2015, down 60% from 2020 levels. And China isn't exporting that metal. They're importing more. India's silver imports hit records in 2024 and accelerated in 2025. The physical is moving east and staying east. Meanwhile, COMEX registered silver, that's the metal available for delivery, dropped from 80 million ounces in October 2024 to 43 million ounces in March 2025. On November 17th alone, 6.13 million ounces withdrawn in a single day. And lease rates, the cost to borrow silver for short-term delivery, exploded to 40% annualized. Some overnight borrowing hit 200%. For context, normal lease rates are under 2%. When banks won't lend silver to each other except at loan shark rates, the physical market is broken. Now here's where it gets geopolitical. Basel III banking regulations, fully implemented in the EU as of January 2025, made it prohibitively expensive for European banks to hold unallocated silver positions. The regulatory burden is 85% of the position value, so European banks exited the silver market. Major LBMA market makers, the banks that actually provide liquidity and maintain pricing, withdrew. Bid-ask spreads in London, normally 2 to 3 cents, blew out to over 20 cents. That's a liquidity crisis. When you can't quickly buy or sell without moving the price dramatically, the market isn't functioning. And China noticed. They restricted precious metals purchases by individuals through banks, but allowed institutions to accumulate. They raised export restrictions. They incentivized direct mine-to-refinery domestic production. They're consolidating control over physical supply, while the West drowns in paper contracts and regulatory burdens. December 2024, a major U.S. bank attempted to settle a large physical silver delivery to an Asian buyer. Couldn't source the metal from LBMA. Had to settle in cash at a penalty. That's not a transaction failure. That's a system failure. We are deep in stage 2. The fracture is widening daily. Stage 3 is at the door. Check. So what happens when stage 3 fully arrives? 2 completely separate markets. In the West, COMEX and LBMA continue trading silver futures, but nobody cares what the price is because you can't get physical delivery. Contracts settle in cash. Speculators trade paper back and forth. The exchanges report a silver price, but it's meaningless because it doesn't reflect physical transactions. It's just a number on a screen. In the East, Shanghai, Mumbai, and Singapore trade physical metal. The real price, what people actually pay for ounces they can touch, is set there. Premiums over Western paper prices hit 20%, then 30%, then 50%. Industrial users who need silver for manufacturing pay Shanghai prices. Governments building strategic reserves pay Shanghai prices. Investors wanting physical metal and allocated storage pay Shanghai prices. COMEX becomes what it always was, a casino for speculators who never wanted metal anyway. And here's the critical part. The West can't just start producing more. China controls the refining. They control the supply chains. They've locked up long-term contracts with mines in South America, Africa, and Australia. This isn't a price war the West can win by printing more contracts. Physical metal doesn't care about your futures exchange. The region with the metal makes the rules. So here's what this means for you. First, understand that the silver price is about to stop meaning what it meant for your entire life. Right now, you see one number, $62, $65, whatever it is today. Soon, you'll see 2 numbers, Western paper price and Eastern physical price. The gap between them is your wake-up call. Second, if you're buying silver, understand where your metal actually is and whether you can access it. Silver in a London vault allocated to your name? Maybe. Silver in an ETF that promises to hold silver on your behalf? Read the prospectus. Many can settle in cash if physical isn't available. Silver in your possession or in a private vault where you control access? That's physical. That's what matters. Third, recognize this isn't just about investment. This is about strategic resource control. If you're in manufacturing, if you need silver for products, your supply chain is about to get drastically more expensive and complicated. Sourcing from the West means paper and delivery uncertainty. Sourcing from the East means paying Eastern prices and accepting Chinese supply chain control. Fourth, understand the geopolitical implications. The West is losing pricing authority over a strategic metal. That's not a market event. That's a power shift. For 150 years, London and New York set commodity prices because they controlled the financial infrastructure. Now, the East controls the physical supply, and they're done accepting Western prices. This is what de-dollarization looks like in commodity markets. Fifth, position appropriately. If you hold physical silver, understand its value is increasingly tied to Eastern physical markets, not Western paper. If you trade silver futures, understand you're trading a derivative that's losing its connection to the underlying asset. If you're accumulating for long-term protection, focus on forms that are globally liquid and recognized. Coins, bars from major mints, allocated storage you control. The window for buying physical at reasonable premiums is narrowing. Right now, you pay $3 to $5 over spot. When stage 3 fully arrives, premiums will be 20, 30, 50 over spot. Eventually, none available at any premium. Dealers will source from Eastern markets at Eastern prices and add their margin on top. You'll be paying Shanghai prices in dollars, wondering why the COMEX number is so much lower and why nobody will sell to you at that price. The pattern is screaming. The data is clear. London is losing control, Shanghai is taking it, and the world is splitting into two silver markets. One for paper traders who never wanted metal, one for people who understand physical assets win when systems fracture. If this made sense, if you see the pattern forming, subscribe now, because what I've shown you is just the beginning. The silver pricing collapse is one symptom of a much larger system break. In the next video, I'll show you how this same pattern is playing out across strategic commodities: cobalt, lithium, rare earths, and what it means when China controls the physical supply of everything that powers modern technology. Subscribe, watch the next video, understand how the commodity pricing system is fracturing along east-west lines, because the people who recognize this pattern early don't just protect their wealth, they position themselves on the right side of the greatest resource power shift in 150 years. The clock is ticking, the markets are splitting. Choose your side.